Hello, everyone. Hello, Juneteenth family. It is a pleasure to join you on today. My name is Athenia Rodney, President and CEO of Umoja Events and co-coordinator of Juneteenth New York City. We are so ever appreciative to have you joining us on today as we have our second iteration of our lunch and learn learning labs. We are very excited about our conversation today, especially as our conversation last week kicked off, where we talked about so many things in finance. So many areas that we need to, the 6 areas that we need to focus on in order to stay out of debt and to build wealth and to be able to just bring um, financial stability to our family and to our community overall. Today, we have some amazing people joining us. So we have Renee that is coming back to kick off what debt is really and to go really fine tune into depth with that. And we also have a special guest that she is brought on with us, and that's Carnell Newsome. So I'm going to tell you a little bit about who they are as I bring them up. And so just for those who were not with us last week, Renee Rakina is a CPA and financial literacy coach and advisor. She works throughout the United States to help understand how money works and to help us understand how money works. So you'll see how that her learning helps us learn in the community, and that's something that we should all be doing in some form or fashion to pay things forward. She spent nearly 3 decades in various finance capacities and brings those years of experience along with an education in economics, accounting, and taxes, and the best maximum families' abilities to create happiness around money and goals. So just thinking about what are the ways as a community and as individuals that we can start to build our own financial gain. Her niche is creating financial independence and legacy wealth using life insurance and investment products, and partners with other financial professionals like we have today to create a holistic, customized plan when appropriate. Renee will show you what your parents in school never did about finances and help you to retire as close to tax-free as possible. Her tagline is, I will revolutionize your relationship with money. And I think we all need that. And break the bad habits that you were taught and aren't serving you today. So I'm going to bring up Renee. Welcome, Renee. How are you doing?
Hi, Athenia. Good to see you.
Good to see you again as well, and glad to have you back with us. This is really exciting, and I am going to talk about our next person who you have joining us, which we are ever so grateful that you have brought him in this space, and it's been great speaking to him behind the scenes and get to know him a little bit. But to share with you all, Carnell Newsome has worked for the Financial Services Institution for over 10 years. During those years, he has learned how consumer credit can have a huge impact on people's lives. So some people don't know there's 2 types of credit. There's consumer credit and then there's business credit. And that's another topic, but just want to highlight those 2 differences because a lot of people are not aware of those 2 things. Due to his drive to start his first business while still attending college. All right now, Carnell. Carnell learned firsthand the importance of good credit. Good credit made the difference between home ownership and renting, getting employed and unemployment, and qualifying for an affordable loan and paying it in outrageous interest fees. And I have definitely been playing around with that lately. I think last week I shared that my credit over COVID was able to go up, and now I'm getting all these credit cards, all these loans, all these things like, oh, we can give you 2-3% interest rates, and I'm like, oh really? Now we want to give me 2 and 3% interest rates. I don't need it now. Like I don't have the debt that I had before. So definitely want to bring you on, Carnell. Welcome. How are you doing?
Great, ladies. So excited to be on this platform with you, ladies, and I'm excited to be here today and share a wealth of knowledge along with my colleague Renee. And about some life changing services that can help people to improve their finances.
Most definitely. So I am going to pass it over to you, Renee, and you let me know. Do you want me to bring up the PowerPoint?
Yeah, let's just introduce it. So, hi, everybody. We're back for part 2. I'm thankful for Athenia for holding this forum for us and for Carnell. I always bring in the big guns when I need to, and I brought the big guns today for you because he's got some really valuable information. But I just want to bring you back to where we left off last week, and that was speaking about the 6 pillars of financial freedom. The first 2 we went over were to understand what's coming in and coming out of your family and your budget. And the second part was having proper protection for your family so that if any event happened where you lost an income earner, at least life insurance would come in and it would take care of the family so that the family didn't need to separate. But it does a lot more than that. It can create wealth as well. So now we're talking about step 3. It's all about what is debt, how do we use it, why, and how does it work? So Athenia will bring up my slides and we'll get right into some stats about what does it really mean to have debt. And what I want to show you in the next slide is what debt is doing to us and where we are in debt. So today I'm going to have a couple of slides and Carnell and I will talk to you about things in between here. But in the US here's the household debt and the type of debt that we're incurring. So there's about $16 trillion of debt. Now, the type of debt, mortgage is the highest, student loans is next, and then auto and credit cards. Now, people are using credit cards to run their lives. Now, running your life means I don't have enough money in my bank account coming from my job or my business, and I'm spending more than I have, so I'm leveraging credit cards. So that is going up, especially during the pandemic as well. The slide sort of threw the numbers at the bottom, but for people who don't understand what trillions is, I wanted to sort of lay that out for you. 1 trillion is 12 zeros after the 1. 1,000 is 3, a million is 6, 100 million is 8, a billion is 9, 100 billion is 11 zeros, and a trillion is 12 zeros. So can you imagine $11 trillion of mortgage debt? And during the pandemic, some people are in forbearance, some people are in foreclosure. They're not able to pay, or we're just saturated in this country with debt. So total US debt, the first part of debt for the US is $29 trillion. And in the consumer's hands is 16 trillion. So that's a lot of money. So next slide, please. And then we'll talk about what's happening with that debt. So we're spenders. Oh, there it is. So we're spenders. We're spending more than we have coming in. Next slide, please. So what does that mean? In today's society, 3/4 of us are living paycheck to paycheck. And that's not unusual. You're hearing your friends say, I don't really have a lot of extra. I'm break even. What am I going to do? I've missed a payment. They're literally living paycheck to paycheck. And then most people are using credit cards to manage their expenses throughout the month. So the average credit card balance in a family is about $6,700. 42% of people cannot live without financial support. Adult children have moved back home. They've come back from college and they've stayed. They have not moved out, or the parent is sickly and now the family is now combining generations. So that is happening as well. Next slide, please. And then 2/3 of Americans say they would struggle to come up with $1,000 in an emergency. So that's step 4 that we'll talk about after debt. It's having emergency funds so that you don't run up a lot of debt. But 85% are anxious. You know that anxiety contributes to your mental health, your physical health, and everything else. So if we are not managing our money properly and we're stressed every day, listen, it's worse than acne popping up. It's more than that. We can have heart attacks. We can have strokes. We can have high blood pressure, cholesterol. Everything can go wrong. So we need to be cognizant of this and actually taking proactive steps around managing this. And 53%, more than half of the people in this country, are dissatisfied with where they're working or their environment. And you've heard of the Great Resignation. That's what's happening. People are walking away from either toxic environments, not feeling that they're earning their worth, or whatever it is. It's just not conducive to their family life. People are very, very unhappy. Okay, next slide, please. So what happens when you're unhappy? You have to placate yourself. You might spend a little bit more. But here's the impact of spending. And I want to focus on, because this is a Juneteenth Learning Lab, I want to focus on the biggest ethnic group that has a lot of buying and spending power and how they're utilizing that money. So there's $11 trillion in debt, but it's not all attributable to one economic group or one ethnicity. In the African American and Latino community, we spend about $1 trillion a year, but we only keep about 20 billion in our community. That's less than 2%. Within 6 hours of earning money, it generally leaves our communities. Now, some places will say 30 minutes, which is a scary factor, which means we're not reinvesting in our own communities. But 6 hours is generally what they say is happening. But if you look at a couple of other ethnicities, 20 days in the Jewish community, 30 days in the Asian community. So what is that saying? We're spending, we're keeping the economy going, but we're not doing anything to help us benefit ourselves. So if we go to the next screen, this is another scary fact, the demographics of debt. So now if you're spending and you have $1 trillion, where is that money going? It's not creating wealth for you, because African Americans and Latinos, we have the lowest in terms of net worth, which means we don't have the assets to support where we spent the money. So this is very scary. 24,000 per family is net worth on average for the African American family in the United States. So we need to do something about that. And I always say that having too much debt, or the debt that doesn't support us, is what's robbing us of our wealth. So that's why we wanted to make sure that we came to you with this specific topic today, because I know that next week starts Black Friday, and then after that is Cyber Monday, and then we're on the race to the end of the year holidays. So if we can impress upon you the impact of what happens with every dollar that you spend, you might make a few different choices. And then maybe you start the beginning of the year not in so much debt, but in a better place and feeling better about money in general. So next slide, please. And I don't have too many more. So how do we split up debt by generations? Generations are the time frame or the era in which you were born. You know, we love to put names to everything, monikers. So the silent generation is our grandparents. They're 75 and above. They don't have much debt because their parents did not grow up in debt. So everything that we talk about around money comes with learned habit. So like I said in the beginning, if you don't learn it in school, you learn it from your parents, and they didn't learn it from anyone, proper habits and how to utilize debt or anything else, you end up making the same decisions and mistakes that they did. So silent generation doesn't know, they're not used to living in debt. They followed their parents. Baby boomers, retiring now, born between 1946 and 1964. They are age 56 to 74. They have more debt than their parents did. Why? Because they had jobs and careers that afforded them pensions, and they thought, well, I have money coming. Don't worry about it. I'm getting a check every 2 weeks. I like these things. We're going to start living like the Joneses. They have a nice car. We have a nice car. They have a house. We're going to have a house. They're going on vacation. We're going on vacation. So it was all about keeping up with the next person, right? So now they're now building in the habit of purchasing and have instant gratification. And their children, because again, we didn't learn it in school, now they're teaching the Gen X's. Gen X's are 40 to 55. You took them and gave them all of the new ideals that you created. You taught them to spend, go to college, get a good job, get a good career, buy that home, buy that car. Everything is buy. College debt is going up and up every year. So now Gen X is the highest group in debt because we got all of our habits from our parents, plus some. Now, we're starting to realize, and I'm a Gen Xer, something's wrong. Something's not working because I shouldn't be in this much debt and I'm not enjoying my life. I'm not creating wealth, right? So our children or our younger brothers and sisters, they're watching us. They're the millennials. Millennials are 24 to 35. They're looking at us saying, yeah, you got a nice house, but look at you. You're working all the time. You're not saving any money. You're not enjoying yourself. You look sick all the time. This is what's happening. They're stepping back saying, I don't think you're doing this right. I'm not going to follow everything that you're doing. And even some of these are our youngest children. And then the Gen Z says, all of you are doing it wrong. I'm not going to be stressed out about money. I'm not going to go into debt. I'm not doing any of that. I'm going to manage my life more so on cash. That's why they're the lowest. Now, that means that we've done such a bad job as mentors and coaches when it comes to money that they're willing to not follow us and figure it out themselves, which in this situation might be the best thing for them, right? Until we can put proper education out there around financial literacy, that means that they are going to do what they want to do, which is a complete opposite of us. And that's going to save them for the moment. So let's go to the next slide. So what we want to focus on today is concepts. When it comes to money and debt, what you want to understand is the power of compound interest, the time value of money, and the rule of 72. I'll give you a quick example on the next couple of pages. And then I want to bring in Carnell because this is where he's most powerful, where he's talking to you about how all of this works. So Athenia, can you flip me to the next slide, please? Okay. So what does compounding interest do? What does it mean? Now, you know what interest is. Interest is when you borrow money, you pay it. When you earn money, you receive it. So it works in our favor when we're earning money and investing, and it's not in our favor when we're paying money and we're borrowing. Compounding just means that something is growing on top of the previous thing. Think of 1 penny plus another amount on top of that, but you still add in the first 1 penny. So it's compounding so that you're getting to grow whatever it is quickly. Now, again, it works in your favor when you're earning it, but when you're paying it, it does not. So next slide, please. What happens with the time value of money? Now, these two people are investing to age 60. Now, one is investing on the left for $1,000 a month, and then the one on the right is investing $2,000 a month. Starting with age 30 is when Ram, the guy on the left, started to save. Shyam started to save 15 years later. So he has 15 fewer years to invest. So now they both put in the same amount of money, 30 years, and it is $360,000 with an 8% return. But if you look at the time value of money, meaning Ram started 15 years earlier, his money has grown and Shyam's money doesn't catch up. So the fact that you started sooner, and think about your 401k. If you start earlier saving money, you don't have to save as much because you get the power of compounding and interest on top of that. So now this slide just depicts that you can't get back lost time. You need to start saving and investing as early as possible. But where does that money come from? It comes from getting out of debt. So my next slide is going to show you what the impact is. Now that was on investing, what the impact is on paying. So now there's a concept called the rule of 72. And the rule of 72 says interest works in your favor when you're earning it, and it works against you when you're paying it. If you want to understand how quickly your money will double, you use the number 72 and divide the interest rate that you're either receiving or paying into the number 72. So if our banks are giving us 1%, and that's gracious these days because there's a 0.0 in front of that usually, divide that number 1% into 72, and it takes nearly 72 years for that money to double. It's about 69.66. So think about putting money into a bank account or under your bed, which is almost the equivalent, just a regular savings account, and it doesn't really grow. So now if you think about 10%, 10% is what? The stock market average return. Divide that into 72, and it's a 7.2%, 7.2 years for your money to grow. So a little bit better, a lot more risk that you're taking on, but that's not a bad thing either. We'll talk about that in the next session. But this is where you start to understand how compounding helps you when you're earning. But here's how it hurts you when you're paying. Think about your credit cards. Credit cards can be anywhere between 15 to maybe even 26%, 27, 29 in some cases. If you have a non-branded store card, It could be 29.999. I've seen those. So think of 20% divided into 72, 3.8 years. That's a credit card. That means that the amount of money that you owe that credit card company is doubling within 4 years. But your money in the bank doubles every 72 years. So how do you keep up? You have to keep earning more money. Now, maxing out that 29.99 credit card, and I think some of you know who it is by now, a couple of those stores, your money is doubling in less than 3 years. So paying the minimum on a credit card doesn't get you very far. So it works in your favor when you're earning. It works against you when you're paying. And this is the more reason why you want to be out of debt, so that you can then in turn invest that money with a better return so that you can continue to grow your wealth. So this is why I say that paying interest on credit cards and student loans and mortgages and the such, they can prevent you from creating wealth if you're not managing your money properly. Okay. So I think that's the last slide, Athenia. So what I would like to do is, this is a great introduction to bring in Carnell, because Carnell can speak to us about what do we do now that we have debt, and how do we even think about this in the future?
All right, all right. Well, thank you so much for that introduction. And what do you do about debt? Well, the first thing is this, ladies and gentlemen, is you need to create a budget. A budget is something that everyone needs in place, and then you need to also realize like which credit cards you're paying the highest interest rate on and which credit cards you're paying the lowest interest rate on. So let's just say that you're in debt. You have a lot of credit card debt. So what you want to do is this is again is cut expenses, and then the money you're saving, you want to use that money to pay off the credit cards that have the highest APR. Use those first, pay off those higher APR, as you said with the rule of 72, that if you have debts on credit cards, it takes just a couple years before even the money even be touched. So you definitely want to use that money to pay down credit cards. Another thing is this too, guys, is make sure that whatever you do with your credit cards, you keep your balances on them way below 30%. So anytime you're carrying a balance on a credit card at 30% and higher, what happens is you're giving up some of your credit points. So if you have a limit on a credit card at $1,000, you don't want to use no more than 300, which is 30%. Ideally, if you want a higher credit score, you want to keep their credit card utilization ratio below 10%. Under 10%, what it does is it gives you a better tier. Now, where I'm going with that is that I have a lot of people that come to me and say, hey, I'm thinking about doing debt consolidation. I'm thinking about maybe borrow money from my 401k to pay off debt. And that's fine. But the best thing to do is to leverage other people's money. So if you can improve your credit score and maybe get your credit score at a 720 and higher, you can actually apply for a credit card, usually with 0% interest. And then what you can do is you can take all of that debt that you're paying high interest rates on, you can consolidate it into that one credit card at 0% interest. And most of these credit card companies will give you about a year to a year and a half to start paying on it before the interest kicks in. So it's a great way you can pay dollar for dollar to pay off all of that debt. So what I want to do is I want to bring it back to Renee, and we're going to kind of role play a little bit, and we're going to go over some scenarios with you guys to help you guys to improve your finances. So Renee, what other questions would you want to bring up?
What would I do if I needed a car, but the car company said my credit wasn't good enough?
Yeah, good question. So the first thing I recommend is know your FICO score before you even go into the car dealership. So there's a website you can go to. It's called myfico.com, myfico.com. Go there. You can see all your credit scores. There are several scoring modules that FICO has, but you'll be able to see what credit score that the dealership is seeing. If your credit score is low, like in the 4, 5, 6 range, you want to make sure you get your credit score above a 700. Then what you want to do is look at your credit report. Anything you have that's up there, maybe there are high credit card balances, as I said earlier, work on getting those paid down. If you have negative items, highlight those items, what they are, write them down, and do something to correct them. You're able to dispute items on your credit. You're also able to call some of your creditors and work out some type of arrangements with them if you have negative items for a file deletion. But whatever you want to do, improve your credit score first. This way, when you walk into the dealership, you're going to get the best interest rate. The cool thing is you're going to know what your credit score is. So when you go in there, you can say, hey, look, I already got my credit. What can you offer me for finances on this loan before you pull my credit? Because the last thing you want to do is have a lender pull your credit several times, because those inquiries can actually make you seem like you're desperate for credit and can actually drop your credit score. So that's what I would recommend. Get a copy of your credit report first, know what your FICO score is. Let's work on improving that credit, and then you can go into the bank and feel confident, and you can get the loan of your choice.
Okay. Can you talk about bankruptcy? Sometimes people say to me, I think it's time for me to file for bankruptcy. Do you see those? And when is the right time to do that?
Yeah, good question. Bankruptcy is not a bad thing. A lot of business owners, use bankruptcy as a tool to get out of debt. And you can actually file for bankruptcy and within 6 months later have a 700 credit score by just applying for secured trade lines and things like that. And what a secured trade line is, it's like a secured credit card or a secured installment loan that shows your ability to pay it on time. So, uh, again, I tell most people is this: if you want to make a major purchase like getting a home, you don't have to file bankruptcy. There's ways that you can handle your debt. And if you have too much debt, then of course bankruptcy will be the choice. But what you want to do is this, just to protect your credit. If you're going through financial hardship, the first thing you want to do is contact your financial institutions. Most of your financial institutions, they do want to work with you. They're not your enemies. So give them a call and say, hey, my name is Jane or John Doe. Right now, I got laid off due to COVID. I'm a single mom, or whatever your situation is, and I can't pay you right now what I want to pay. Can I pay the interest only for a few months? A lot of the banks, they will allow you to pay interest only for 6 months. That's all the money the bank's making anyways. You can also ask them to defer your payment for a couple months. What that does is it gives you some time to get back on your feet financially. So I tell most people this: defer your payment for at least 2 months. Then once the 2 months kicks in, call the bank again and ask them, can you pay the interest only for 6 months? Within those 8 months period of time, that should give you enough time to get back on your feet financially. So that's one way you can actually keep your credit clean and avoid yourself going into bankruptcy. Now, let's say you have credit card debts. As we know that a lot of credit cards, especially these store department cards, they get high APRs, right? So that means that if you have a high limit on it, your minimal payment, depending on what your balance on a credit card, could be as high as a car payment. So what you can do is a lot of times if you have a 401k, so many 401ks, they'll allow you to borrow from it for hardship, right? So for medical collections, credit cards, things like that, borrow the money from the 401k, pay off the credit cards, and then pay yourself back at a very low interest. So that's a good way to save your credit. So this way you don't have to file for bankruptcy. Again, if you have like 50,000, 80,000, 100,000 in debt and you can't pay it, of course, you want to file for bankruptcy to protect your assets. But to avoid it, just contact your creditors, let them know what your situation is, and 90% of them will work with you.
So bankruptcy doesn't really mean that you don't have any money, right? It just means that you owe more than what you have.
That's correct.
Okay. Now, do companies still view bankruptcy as a really bad thing?
They do. It all depends on what type of financing you're going for. So companies do look at bankruptcy as you are a high risk. You're a high risk of defaulting or not paying them back. So what happens is it takes you at least a couple years to reestablish your credit. But the cool thing is this: is that there's guys out there like me. We can help you. We can assist you on what to do to add on some positive history in the credit report, and I'll just give it to you. So let's just say that you did go through bankruptcy. Things happen, and we get it. We're in a finance world. So let's say that you did went through a bankruptcy. What you can do is this: is you can actually get someone that you're close to, and you can actually add them to add you to their credit cards as an authorized user. What that does is it allows you to piggyback, right? It allows your score to rebound. Typically, you want to get a credit card with a 10-year history. Usually between a 10-year length of credit history to 15 and longer gives you more of an increase into your credit score. So now when a lender does look at your credit, they can say, wait a minute, this person has a 10-year history of on-time payments, very low utilization ratio. It's going to make you a better candidate to get in finances. Again, lenders do look at bankruptcies pretty bad, depending on what type of financing you're going for. So by adding on multiple trade lines, that can actually help you improve your credit score.
That's a good thought. Okay. Now, when you add that person onto the credit card, are they responsible? Are they a spender? Are they responsible for the bills? How does that work?
Yeah, good question. So if I add you to my credit card, you're really not responsible for the debt because you're just an authorized user. But it could hurt you. So if I end up, missing the payment, or if I end up, running high credit card balances, that is going to impact your credit score, positive or negative, depends on how I pay it. So if you are being added on someone's credit profile, make sure that person pays it on time. Now the cool thing is, I don't have to give you the credit card either. So I can literally take the credit card, I can chop it up. Most people that are wealthy, they do this for their kids. There's some credit cards that will allow you to be added on the credit card as age of 13, right? This is why when the kids turn 18, they got a 750 credit score. Now they can go into the bank and they can get finance in their own name. In fact, a lot of parents end up finding themselves in trouble because of student loan debts, right? That's a big problem that's going on in today's economy. So if you set your kids up at an early age to have excellent credit, when they turn 18, they can get the student loan debt in their name. Now, the reason why the kids can't get it a lot of times is because, number one, they don't have any credit. So now they're trying to build credit, but we're putting them in debt with these student loans just to build credit. We don't want to do that. So the best way to really protect your credit and set your kids up and their kids up is teach them early, as you were saying earlier. When it comes to financial literacy, it's one of the things it's not a conversation topic. It's not being talked at the dinner table. It's not being talked around the middle class or the poor class. So it's something that we got to start really implementing at a young age. This way, when these younger kids get older, they understand how credit is. I mean, credit, to me is up there with oxygen. You need it. You need it for everything. You need it for a job. You need it for a background check. You need it to get a car. Even dating sites, just joking, is doing credit checks. They should, but credit is up there with everything.
It is. If you apply for an apartment as a renter, they pull your credit report.
Absolutely.
Right? So
Absolutely.
it's in everything. And I'll tell you that it's part of life insurance as well. When you put in an application, they pull your credit report. If you're not paying everybody else, you're not going to pay for your life insurance either.
So you mean to tell me that if you have a low credit score and then someone next to me has a higher credit score, we both have this good health, you mean to tell me that I may pay a higher premium?
Absolutely. And I've seen people declined because they have unpaid charges on their credit report.
Wow, that's interesting. Because life insurance, think about it. We got insurance on our cell phones, we got insurance on our cars, we got insurance on our homes. Everyone needs life insurance. And I'm glad you mentioned that. With my services, I help a lot of people get into homes. And one of the things I stress to people is you need some type of asset protection to protect your home, especially to protect your income. Because if you're married and let's just say that one spouse, something happens because we're not here forever, and that person, you lose their income, now you're down to one. So the cost of life insurance, I think, is really affordable. Am I right?
It is.
So by having a good credit and also having your ducks in order, that's a huge way too to build money and also to save money as well.
Yeah, it definitely is. Ever since the internet started and all of these databases, motor vehicles and credit reporting and FICO and everything touches each other these days. There's nothing that you can do that's in isolation anymore because motor vehicle report is part of your application as well. So
Wow.
if you're a risky driver and you're dangerous and you have a lot of points and you're having accidents, you're going to kill yourself early. life insurance will be triggered. So there's a cost to doing business and a cost to living. But you know how you say we're not having these conversations. If people say to me, well, I don't talk about that kind of stuff with my friends, but you should be, because if you're not having those conversations, that means you guys are not helping each other as a friend base, as a family base, or anything else. You can't uplift yourself if you stay with the same group of people who are having the same old conversations from 20 years ago. We have to be thinking and talking about these things in a way that protects ourselves, moves us forward, and protects our family, and including the next generation.
Yeah, I agree. And then another thing too is that life insurance is better to get it when you're young. Would you agree?
Definitely. It's
You
less
know,
expensive.
less expensive, and then also too, depending on what type of insurance you get, it can also build cash value. And then with
That's
that
true
cash
too.
value, I'm learning this from my parents, is that cash value you can actually take money out of there and you can use it towards buying a home. You can use it towards paying off a debt. And if I'm right or wrong, correct me. But you can also, whatever money you take from it, from the cash value, you can also pay yourself back. Is that fair to say?
That's true too. And
Okay.
there's also good tax benefits related to it as well sometimes.
So how does the tax benefits works?
So depending on the type of life insurance it could be a tax-free distribution to you. So you're growing your own money tax-free. But there's absolutely ways that you can grow cash inside of life insurance. The IRS allows it. But a lot of times, many people aren't aware of that. They always thought that life insurance was, oh, it's for just burying you. It's for the dead. It's for, you don't need it until you get old or until you're married with children. No, life insurance does lots of things for you. It's living insurance now. It can
Yeah.
actually create a lifestyle for you.
And that's what I always thought it was too, was for something that was there in case, something happens to you. Is pretty much for your, to cover someone else's living expenses or your burial expenses. But based on what you're telling me now, it could actually be a tax shelter because you say it can go in tax free, right?
Yeah, it can grow tax-free.
And the money going into, you pay no taxes going in, and then taking it out, same thing. Uh,
You've paid the tax already before it goes in, almost
gotcha.
like a Roth sometimes. And then
Mhm.
as it grows, it can be tax-free based on
Okay.
certain circumstances. But yeah, you do have that ability. So the way that insurance is designed, you can eliminate yourself from getting into new debt by utilizing that asset that you created that's growing cash and just borrow from your own set of money.
Yeah, and the reason why I mention that for is because I tell people all this time, the money that you're saving by having excellent credit. Let's just say you had a car loan and you were paying $600 a month. There's people out there paying $800 a month for a car payment. And let's just, and because the credit's bad, they're paying 19.5% interest or higher, depending on what state you live in and what the interest rate is. And let's just say that you got someone with a 560 credit score and someone with a 720 credit score. The person with a 720 credit score, that car payment might be a third, right? It's going to be cut down way more than half. So the money that they're saving, why not take that money if they're used to living that lifestyle already and then invest it, right? They can get some type of insurance that can compound, like you said, the rule of 72. They
Mhm.
can take that money and invest it, and then over 3 years, 10 years, that money is going to grow. It's again, it's something's not taught anywhere. And I feel like as the economy changes and we pivot, people need to be more educated on this.
Yeah, I think so too. I was just scrolling through because now I see that there's comments in the chat. So there's a couple of questions too. So Angela said, transferring higher interest card balance to a 0% card can pay down the debt also. How are those still available, and how do people get those?
Yeah, good question. So usually when your credit score improves, there's sites you can go to. They'll tell you your pre-approval offers. They'll say good to excellent. You can also check with your credit union. And then what you want to do is look at usually what are usually the FICO score requirements for those credit cards, and then find out, what the terms are, because you don't want to get a credit card with 0% interest for 6 months, because what happens is 6 months comes in, now you got to pay the interest. So I always tell people do like a year and a half. Why? Because most people who have jobs, W-2s, if they have taxes taken out, usually the beginning of the year, some of those folks are getting a tax refund. And so with that tax refund that you get in, you can take that money, include it with every money you've been paying, and you can pay off the debt before the payment kicks in with the interest. So always when you go for a 0% interest, look for at least about 16 or 18 months, a year and a half, something like that. Those are the best credit cards to go for. Again, it's a great way to pay 0% interest, dollar for dollar. That money goes towards the principal. Now, the problem is that you don't want to be applying for these credit cards if your credit score is a 560 or a 580, because you're going to get denied. That's why it's so important to look at the fine print and say, okay, what is the credit score required for it? And let me work on maybe doing some other things or working with someone like us who can educate you and coach you on how to reposition your finances. So this way you can put a budget together, pay down whatever debt you got to do, or improve some negative items for credit report. And then once you get that 720 and above, apply for that credit card, 0% interest, and then you can transfer the debt over.
Perfect. Okay. So you need to have better, not great, FICO score already in order to be able to get those 0%. Okay.
Yeah.
It's weird that the whole industry is designed against you. When you need the help the most, it costs you the most or you can't get it. And when you don't need it, they're knocking at your door to give it to you.
That's correct. That's correct. Because remember, the banks, they're in the business of making money. And how do they make the money? The interest, right? And something a lot of people don't know too, and I'm not going to go off topic, is when you get a mortgage, 30-year fixed mortgage, let's say the interest rate was 4%. It's not really your interest rate. When you add on the compound interest on it, that interest rate is usually about 300%. It's not 4%, usually until the very last payment. So again, the banks are in the business to making money. They always win and never lose. So it's really important to be taught about this.
Yeah. It's the financial industry is designed in their favor, like a casino, so that you don't win the round. You can play the game and utilize the round, but it's not designed for you to win.
That's correct.
Okay.
So I see we got Earl's back. Is there any questions that you want to ask? You'd like to ask us?
Yeah, there were just a couple of more questions I just wanted to share. So Jennifer said, how long do different types of things fall off of your report? Late payments or something more severe like threatened foreclosures?
Yeah, good question. Depends on where you live at in the United States. Most negative items falls off people's credit report in 7 years. And that includes like late payment collections, things like that, charge off. It's 7 years. Chapter 13 is 7 years. Chapter 7 is actually 10 years. But here's the thing. You don't have to wait 7 to 10 years to get those items off. There's laws put in place. One of them is called the Fair Credit Reporting Act, and one of them is called the FACT Act. Under those laws, you can actually leverage them, and you can actually challenge how the credit agencies report those things on your credit, and those things can get removed. So that's why there's financial literacy companies that are out there like mine and like what Renee does, and we can help you to remove some of those negative items. We can't remove everything. If we could, that would be awesome, but we can at least show you what to do, give you a game plan on what to do to improve that credit score so you can have excellent credit.
Well, thank you for sharing that. I know a lot of people are, contemplating between getting filing for bankruptcy and not, and that definitely helps them to understand what's the best option for them. We have a question from Angela. Why should I pay for insurance for so many years and I'm young and healthy?
Well, I can take that one.
That we get, especially when you get those things for Gerber Life. Like, why am I paying for life insurance for my newborn baby?
Because that's the most critical time when your baby is a newborn, all the way until the end of their lives. So what happens with life insurance is not only are they looking at the things that I mentioned, like your credit and your driving record and everything else, it's based on your age and your health. So we don't know. We know that we're going to get older, and every year things cost more, just like food and everything else and bread. But what about your health? You don't know what's going to happen to your health tomorrow. There could be something genetic in your family that no one realizes is going on, and all of a sudden it rears its head tomorrow. they take time to figure it out, and you become uninsurable. So for the rest of your life, you may never be able to get life insurance under any circumstances because this genetic problem happened. Or maybe it happens to you later in life. You just develop something. It could have been in your family, you know about it. And listen, hey, it popped up now, and what are we going to do about it? Or it just costs you more because now, in the eyes of the insurance company, you're more sickly. Yeah.
Bigger liability.
Yeah. So people have to think in terms of the insurance company's eyes. Is that person at risk of passing away prematurely too soon right now? Or, does it look like, based on their lifestyle? I'll tell you, our people, health, height, weight combination, critical when it comes to them. It's a marker. If you're unhealthy between your height and your weight, your build, that's an identifying marker that something else is going to happen to you inside your body. And once you get one thing wrong with you, here comes the next. You become at risk of not being insurable. But also think about this, separate from insurance, you're cutting your lifespan short because you're not healthy enough for your body to continue. So in their eyes, oh, I have to pay out sooner.
Right.
I have to pay out more. And maybe I wasn't planning on paying out because it was a term policy. So those are the factors in why you might want to consider paying from a young age. And then if you're investing and it's a life insurance policy where it's growing cash, absolutely start as soon as possible because of compounding.
Right.
The sooner you start, the more you will have.
Wow. Yeah. Thank you for sharing that. It definitely helps to, I know, open my eyes with a lot of things. I mean, I've always had insurance for my children as soon as they were born. But to speak to somebody else, for me, I'm like, we never know, not to get all biblical, but we never know the day, the hour. And so many people are burying their children. And I'm like, especially in our community. And my question is always, why don't we have life insurance? Like, we should be the first people to have life insurance because we know that the behaviors that are surround where we live are not the best of conditions. And what are we doing to protect ourselves in the back end so that we're not having to do all of these GoFundMe's and ask people for support, but we're being proactive to, like you said, ideally creating generational wealth. Not to say that, let me go do it because I know my child is going to die, but at least having the foresight to be prepared in the event that something like that does happen, that you have the support to be able to do something. I remember telling my agent, it was like, why do you want so much money on your children's life support, life insurance? I said, not for nothing. I said, if my child ever dies, I need a couple of $1,000s to go on vacation for a couple of months because I need to figure out my life again and how my life looks with my child not being in it, or even move, or to be in a space where my child used to be and to not see that child there again. I said all of those things dredge up certain memories, and they were like, I never thought about it like that. And I said, yeah, a lot of people don't think about it like that. And I said, but that's a space that I had to live in with my grandparents died. And I was like, I don't know that I would want to do that with my child. So thank you for sharing that. And I think we had one more question before we close out. Angela shared, what tools are available to have negative items removed from your credit report?
He said, "What tools are there to have negative?"
Available. Mm-hmm.
Yeah, so there's all types of stuff you can find online. I mean, I tell people all the time that credit repair is something that you don't have to pay for. You can find the resources online to do it yourself. The only problem is you got to know uh, the right language. You got to know the right citations. You got to know what you're disputing, how you're disputing, how the credit agency is going to receive it. So it's better, to be honest with you, give it a shot yourself. But there's really no tools. You got to use a professional, or you just got to study, because there's so many different laws out there. There's a Fair Debt Collections Practice Act. There's the Fair Credit Reporting Act. There's the Fair Telecommunication Act. There's so many different laws out there. And then also underneath each one of those statutes, there are like plenty of citations that's out there. So you kind of got to really understand what you're disputing, how you're disputing it. So the best thing to do is contact a professional, let them help you, or just become a good student and find someone you can follow online and just study them. There are a lot of influencers like myself that have YouTube channels, and you can go to our channels and you can just watch them. They'll give you the templates, they'll give you the letters, they'll tell you what to say. But again, the problem is this: if you do it wrong, the information might come back. Or you got some people go online to like Credit Karma or annualcreditreport.com, which is great, and they'll do their little electronic dispute. And they don't realize that when you're disputing it online, you're relinquishing some of your rights. So you relinquish some of your rights. So what happens is once the item comes back, they can re-verify, put it back on, and you can't dispute it unless you learn to be
Wow.
professional, unless you do it in writing. So I always tell people there's documentation be conversation all day. So if you're going to do something, do it in writing, or find someone who's got some success like myself and just reach out to me. We'll help you, or reach out to Renee. We'll guide you. So tools is really that's the way.
Get a professional. That's the
Yeah, good.
tool.
Yeah,
Get a
exactly.
professional.
Yeah.
Yeah.
But I've seen people who do it themselves, but it's take them a lot longer.
It's a lot of work. And while I share, if you can put your information in the chat, Carnell, so we can share it out to everyone, because a couple of people are asking for your YouTube handle, and the same thing with you, Renee. I apologize if I got to get that from you all before we got started. But what you're sharing is definitely correct. And we all have a service, and what a service to me is, you could buy all of the food and bring it in your house and cook it yourself, and it would take a couple of hours. Or you can go to a restaurant and order it quick, fast, and pick it up, and know that the food, from a reputable restaurant, and know that the food is going to be good, and it's going to, do what you want it to do. This similar situation here is like, there are professionals that are out in the field. They've been doing this day in and day out. So they know a lot of the nuances that it's going to take you years to probably gain information on, the experiences, the bad and the good, that that you have experienced, is the better for them, so that you'll be able to pass that information on, so that they don't have to go through that same situation. So thank you for
Yeah.
sharing
So
that.
I'm looking in the chat. I don't see a spot where I can chat at. But what I'll do is this, ladies and gentlemen. You can look me up on Instagram. My name is Carnell Newsome. That's what I go by. Facebook, same thing, Carnell Newsome. YouTube, Carnell Newsome. It's pretty simple. So you can just look me up online with my first name, last name, and you should be able to find me there.
Okay. And on Facebook and Instagram, I am Renee Rekenna. On LinkedIn, I have my maiden name in the middle, Renee Weaver Rekenna. You'll see me with the CPA. And you can find me on the Calendly as well, calendly.com/Renee Rekenna, /Renee Rekenna.
Thank you. And there was a quick question. Somebody is asking if someone doesn't die and they have children's insurance, what happens to the money? And that'll be our last question for today.
If they don't die,
Yes.
if the parent doesn't die, and
No, if the child. So if you have
the child doesn't
insurance
die,
on a child and the child does not die, what happens to the money?
then it just was a rider on the policy. Insurance is just in case. Like your car, it's like, I paid car insurance all these years, 30 years, I never had an accident. But if you had, we would have paid you whatever the death benefit is. So it's just one of those things. You're gambling, praying that it doesn't happen, but if it does, then it pays out.
Got it. So thank you for sharing, and thank you both, Renee and Carnell. Do you have any last words that you want to share with the community before we close out?
Just to manage your debt as best as possible. Now that you understand how it can work against you, we need to help you get out of it and find that way of living so that you stay out of debt. Debt is great for a portion of your life or for a time, but you don't want to live and die till the end of days in debt. That's old. Right? If we die owing somebody, no, not anymore.
Thank
Yeah.
you.
And my advice is use your credit to develop generational wealth and not debt. And then make sure you monitor your credit as much as you can, with online shopping, with cyber thieves, stuff like that. Monitor your credit daily, weekly, monitor as much as you can. If there's any changes up there, reach out to your creditors and let them know right away.
Thank you, Carnell. I definitely appreciate you both coming on to be with us and spend time with us, and share your expertise in so many areas. We will not be here next weekend. Or should I say next Thursday, because it is Thanksgiving. And our hope and prayer is that you are enjoying yourself with family and not rushing to go stand on the lines to be outside or rushing to go online, but being present and in a moment. If COVID has taught me anything, it has been that life is worth living and to appreciate every moment as it's not given that'll be here tomorrow. So we definitely hope that you are taking this holiday season to spend time with family and friends. And if not, to make new friends and to make new families. Not everyone has someone. A lot of people lost someone in the last couple of years. And so a lot of people are still in mourning. So also be thankful for what you do have, and celebrate with others. Pour into someone on this season, please. We thank you for joining us for our Thursday Lunch and Learn, and we look forward to seeing you in December, the first Thursday in December. I think that's December 2nd, as we bring Renee back for another word in season. So thank you all and have a blessed day. Bye.